Hey everybody, what's up? Today we are back with another stock analysis. Today we will be looking at Momo or Hello Group. They basically are a social networking platform. As far as I know, they're headquartered in China. I believe they mainly operate in China. But yeah, we're going to get into them. Fairly small company, so definitely some high interest here. But yeah, let's get into Momo. Make sure to subscribe if you haven't. I think like 90% of my viewers are not subscribed, so make sure to hit that subscribe button. Comment below any companies that you want me to review. I do these every single day of the week. And that's it. So let's get into Momo. So Momo, again, social networking platform. They have a few different segments. I honestly don't know what the other segments are, but I know that Momo itself is a social media platform. I'm sure these are also similar. One thing to note, they do have right around 107 million monthly active users as of 2023, which is pretty good for any kind of platform. 1.3 billion market cap, so this is a fairly small company despite 100 million users, which seems like it is a ton, but 1.3 billion market cap, so very small. Again, high risk though, that goes along with that. Target price is $8. Long-term growth rate is negative 12%. And we could see the target price is a little bit higher, but that long-term growth rate could be a little concerning, although I kind of doubt it. Social media, social networking should usually be fairly good. And looking at the growth summary here, honestly, fairly negative. What I'm assuming is happening here is they are being beaten out by competition. That's just my best guess as to what's happening. The 10-year sales growth rate, though, is positive. So there is a positive side to it. But overall, it does not look great for their growth summary. So let's head into their financials and kind of see what we're seeing here. So, first of all, their sales have been declining for basically 5 years now. They had a high of about 2.5 billion in 2019, and since then they've been declining. So, not great. And on top of that, it looks like they haven't really done the greatest job with cutting costs either. Their operating income has been dropping right alongside it, as well as their net income. And actually, in 2021, they took a fairly major loss in their net income. So, not great there. It looks like, however, they have been greatly reducing the amount of shares they have, at least over the past 4 years or so, going from 202 million to 173. So, not too bad there. Definitely a little bit more positive. But overall, if they can't see the growth, they're not going to really make much out of that lower shares that they have. Looking into their balance sheet, hopefully we can see some actual solid growth here. Um, Overall, looks like not much. They have been at a high again in 2019 or 2020, but overall, it looks like their assets haven't been fantastic. Now, one thing I will say is that their debt situation is very manageable. They have 300 million or so in debt and 900 million in cash. So very manageable there. However, they need to work towards making that cash into something that will grow their earnings instead of just minimizing their debt. I think higher debt would actually be something I want to see here. This is also over the past year. They don't have 2024 finalized yet, but we could see the 2024 quarters. And they have just, again, been taking out a ton of cash. And like I just said, actually, they have started to increase their debt. So hopefully, they can use this much larger amount of cash, which again, I was just saying I would like to see higher debt from them. And you can see their short term debt has basically tripled. Hopefully, they can use all of this extra cash to really drive some earnings growth in the future. You could see they're at an all time high in total assets, other than back in 2019, where I believe they had more, but they're at a recent high in total assets. Hopefully, they will start to turn around the overall company. Looking into the cash flows, it looks okay. However, well, actually, free cash flow is across the board positive. However, it looks like it is mostly financing activities that's driving that. It was positive 2 quarters ago despite negative financing. So that is definitely something good. However, they mostly made up for that with investing cash flow, which isn't great either. You could see that other than the past quarter where they've really started to turn around, it looks like they've been funding by selling investments. Now, they did just turn that around, so that's good. They did, of course, issue a lot of debt recently, which we saw earlier, and it looks like the financing cash flow is fairly mixed. But again, that positive free cash flow, either way, is still a good thing to have. And obviously, we could see here their operating cash flow is fairly consistent. Now, it is on a recent low with those sales declines that we've seen earlier, but I think it will start to be turned around just based on where it's looking like they're going to be investing soon with all of the cash that they have now. So I really do think that this will be a good thing for the company in the future. Going into their segment history, we could kind of see where their sales have been declining. So it looks like they have a live video service. This is basically streaming, I believe. Revenue from that has been declining significantly. Value added service, not sure exactly what that is, but their revenue in it has been on the decline. However, not as much as their live video. Mobile marketing isn't very significant, and their other revenue streams aren't very significant either. So, overall, it's mostly just the live video decline really driving their sales dropping. But overall, I do believe just based on how much cash they have and the way that they have been maneuvering their kind of financials, I think they are getting ready to be much higher growth. That seems to be where they're moving towards. Here we can look at the ratios for them. So hopefully we can see some costs being cut. Gross margin looks okay, although again they are lower than their 5-year average. 41, honestly, 41 for a gross margin for a mainly online social media company is very low. I feel like that margin should be much, much higher. SGA to sales is significantly lower than the 5-year average, which is good. We want this to be as low as possible. Operating margin we could see increased in 2023, and we can go to the years here and kind of see where we've been. And it looks like net margin is declining once again, and actually it's at the lowest it's been since 2 years ago, which is not great. Again, operating margin has taken a dip over the past 2 quarters, and looks like the returns on assets and equity is relatively stable, but again, not fantastic. Now, hopefully, all of these can be turned around with all of the cash that they've been taking out recently. I would really like to see them use all of that extra cash and debt that they took out to drive the company to further growth. That's the most positive thing I'm seeing in this company so far. And one thing to note is that including all of the debt that they took out, their long term debt to total equity is barely anything. 1.2% in the past quarter, 18% the quarter before. That is nothing. So they have a ton of room to take out as much debt as they want, reinvest it in the company, drive massive amounts of growth, and hopefully continue expanding and driving their profitability and revenues. I think it can happen just based on what I'm seeing in the numbers here. But overall, there has to be it sounds strange to say, but they need to take out more debt and reinvest it in their company. That is how they're going to turn things around. And that is, I believe, what they are doing already. So now let's get into their recent earnings reports. Hopefully, we can find something good here. And it looks like we do have unaudited financial results. Let's look into that and see what's here. So this is some third quarter highlights. Revenues decreased 12% year over year. Net income was negative 64 million versus a profit from the year before. Other than that, nothing too great. Honestly, all of these highlights are bad. Monthly active users were 12 million compared to 15 million. So active users are declining. Total paying users was 6.9 compared to 7. And that is for the same year, and zero point 0.9 compared to 1.4 quarter over quarter. So overall, really bad. Honestly, across the board, very bad. And there's a comment here that says quarter three was a fruitful quarter for us, satisfactory financial results, and executed well. I honestly don't believe that. I think that's a load of crap because all of these results are bad. And yeah. One thing I will say, invest more firmly in overseas markets. That will definitely help drive their growth. However, in places like the US and Europe, where social media revenues can really be significant, there's already entrenched high maturity companies there that most likely will not be losing market share to this company. So I think if they're going to expand, they need to do it in their own market, which we can see right here where their revenues are coming from. And I believe it should be primarily, yes, entirely China. So overall, I think they need to work on their own market first and then move international, because right now it is looking like they're not doing great in their own market. Other than that, there's just some more highlights here. Again, I really don't think it was good across the board. There could be some other news that we can look into. Sorry, I'm clicking around so much. I'm trying to get back to the earnings. But other than that, I think this report basically highlighted everything, so we're good there. Let's head into their stock chart and see what's going on. So, in their last earnings report, I don't know how, if I missed something, but they have been up a lot since then. Not a ton, but they went up just about 9% the day that they released the earnings and have been relatively up since then. But I don't really see how that happens. Now, their stock price is in sort of a support range where there definitely could be some bounces from here. You could see they kind of have a support line right here and they're up from it. We could possibly see a wedge just based on the way this is moving, but it's a fairly open wedge. I think there's a lot of space to maneuver around here, and also there's just the own rising price right here. So overall, I don't really expect the stock to do fantastic short term. It is in a slight uptrend over the past few months, which could be good, but definitely need to see some better results. Monthly active users needs to be recovered. They need to collect more revenue from their users. And also, again, although it's going to sound weird, they need to take out more debt. They can afford it. They can do it. That is what they have to do to drive their growth, because their net income is not going to cover it. And they're not really doing good with just reinvesting net income anyway, based on the way their revenue is going. So, that's all I have for Momo. Hope you enjoyed. Hope you learned something. Make sure to subscribe if you haven't. Do these videos every day of the week. See everybody in the next one. Thanks for watching.